While everyone else is still believing Ford's optimistic press releases, you could be protecting yourself from the automotive collapse that's already sending shockwaves through small-town America. Patriot Ford in Whiteville, North Carolina, once a thriving business and community cornerstone, now sits abandoned. Its empty lot a grim warning of what's coming. This isn't just happening in Whiteville. Murray Motors in Lock Haven, Pennsylvania is shifting operations miles away to Muncie. Colorado communities are losing their local dealers. From Florida to Washington State, the pattern is unmistakable. Ford dealerships are vanishing at an alarming rate, and it's not by accident. These aren't isolated incidents. They're the first visible cracks in Ford's crumbling empire. While local news reports each closure as a separate business decision, the national pattern tells a far more disturbing story. A systematic collapse is underway, and mainstream financial media won't connect the dots. Behind closed doors at Ford headquarters, executives are scrambling to contain a financial hemorrhage so severe that despite generating a record $50.2 billion in revenue last quarter, the company still posted a $36 million net loss. That's not a typo. $50 billion in sales, and they're still losing money. But mainstream financial media won't connect these dealer closures to the corporate meltdown that's causing them. They can't afford to anger their automotive advertisers. The truth is far worse than even industry insiders are willing to admit publicly. Ford's century-old business model is collapsing in real time, and small-town America is paying the price first. What if I told you that Ford's leadership knows exactly how bad things are, but is deliberately hiding the truth from dealers, investors, and customers? Meet Gary, a former parts manager at Patriot Ford, who showed up to work one morning to find the gates locked. No warning, no explanation, no future. It's really tough, he told us. We're talking about people's lives. The dealership that had been part of Whiteville for generations vanished overnight, leaving employees jobless and customers stranded. We had customers with vehicles in our service bay who couldn't even get their cars back for days, Gary revealed. People who had put down deposits on new trucks had no idea where their money was or if they'd ever see the vehicle they ordered. It was chaos, and Ford corporate offered zero support. It was like they wanted us gone. But here's what Ford executives don't want you to know. These dealership closures aren't random casualties. They're calculated sacrifices. Ford is quietly cutting off smaller dealers to preserve cash, while their electric vehicle division bleeds money at a staggering rate of $1.3 billion in just the last quarter alone. That's over $14 million of losses every single day on EVs that nobody wants to buy. A former Ford regional manager who requested anonymity told us the company has an internal list of dealerships they consider non-essential to their future strategy. If you're a small or mid-sized dealer in a rural area, you're probably on that list, and you don't even know it. The plan is to shrink the network by nearly 30% over the next 5 years, but they won't announce it because it would cause panic. And the most shocking part, Ford's leadership just made a dramatic strategic U-turn that proves everything they've been telling dealers for the past 3 years was a lie. After forcing dealerships to invest millions in electric vehicle infrastructure, they've now delayed their big EV launches until 2028 and are scrambling to develop affordable models they should have built years ago. Dealers who took out loans to install charging stations and training programs for electric vehicles now find themselves holding the bag, explains automotive retail consultant Thomas Wilson. Some of these dealers invested over $2 million based on Ford's promises about their electric future. Now those promises have evaporated, but the debt remains. It's a betrayal that will end many family-owned businesses. So what's really happening inside Ford, and why are small-town dealerships like Patriot Ford bearing the brunt of corporate failures? The answer isn't as simple as the car market is tough right now. It's a perfect storm of catastrophic leadership decisions, financial miscalculations, and market delusions that have left America's automotive icon teetering on the edge of collapse. Let's start with the most damning evidence. Ford's Model E division, their much-hyped electric vehicle unit, has become a financial black hole. Despite doubling revenue to $2.4 billion last quarter, it still lost $1.3 billion in just 3 months. That brings the first half of 2025 losses to $2.2 billion, with no end in sight. Ford went all in on a high-stakes electric gamble, and it's backfiring spectacularly, explains Michael Chin, automotive industry analyst. They're caught in an impossible situation. They've invested too much to back out completely, but they're losing too much to continue on their current path. This EV disaster is just one piece of Ford's financial nightmare. Their quality control issues have spiraled into warranty costs that are bleeding the company dry. Last year, they spent over $2.3 billion just fixing their mistakes, $800 million more than the previous quarter. The quality problems have reached crisis levels inside Ford, revealed a current Ford engineer who spoke on condition of anonymity. We're seeing failure rates on certain components that are 5 to 7 times industry averages. Some of these issues should have been caught in development, but there's intense pressure to launch vehicles faster, and testing gets cut short. Then when problems emerge in the field, dealers and customers pay the price. These quality issues aren't just costing Ford billions in direct warranty expenses, they're destroying consumer confidence. A recent J.D. Power survey showed Ford's quality perception has dropped to its lowest level in 15 years, with 43% of potential buyers citing reliability concerns as their reason for not considering Ford vehicles. Then there's the tariff problem. Ford initially estimated their 2025 tariff-related costs at about $700 million. The real number? They're now expecting to pay $2 billion this year alone, nearly triple their projection. That's not a rounding error. It's a catastrophic miscalculation that shows how out of touch leadership has become. When a company misses projections by billions, not millions, it signals fundamental problems with their understanding of their own business, says financial analyst Rebecca Torres. These aren't small mistakes, they're existential threats. Ford's supply chain vulnerabilities have been exposed by these tariff increases. Unlike Toyota and other competitors who have diversified their manufacturing and supplier networks globally, Ford remains heavily dependent on specific regions for critical components. When policy changes affect those regions, Ford has limited ability to adapt quickly. They've created a rigid, brittle supply chain that can't absorb shocks, explains Dr. Martin Chin, professor of supply chain management at Michigan State University. When you combine that with their forecasting failures, you have a company that's essentially flying blind in a storm. But perhaps the most revealing sign of Ford's desperation is their dividend policy. They're promising to pay shareholders 75 cents per share this year while only earning 11 cents per share. Let that sink in. They're paying out nearly 7 times what they're earning. That's not a sustainable business strategy. It's a last-ditch effort to keep investors from jumping ship. This dividend policy is financial suicide, says investment strategist Rachel Williams. They're burning through cash reserves to maintain the appearance of stability, but it's like using your savings account to pay for luxury vacations while you're unemployed. It can only last so long before reality catches up. The devastating impact on small-town America. Let's look at what Ford's financial meltdown means for communities like Whiteville, North Carolina, where Patriot Ford once thrived. When a dealership like Patriot Ford closes, it doesn't just affect the employees who work there, it creates a domino effect that ripples through the entire community. The local diner that used to serve lunch to Ford employees sees its business plummet. The auto parts store down the street watches sales dry up. The high school football team loses a major sponsor. These dealerships are often among the largest employers and tax contributors in small towns, explains Dr. Sarah Jenkins, an economist specializing in rural economics. When they disappear, they leave a hole that can't easily be filled. It's like removing a load-bearing wall from a house. The whole structure becomes unstable. In Whiteville, the closure of Patriot Ford meant more than just empty buildings. It meant families forced to consider moving away for work. It meant customers driving an hour or more for vehicle service. It meant community events and charities losing a major supporter. Linda Matthews, who ran a florist shop near Patriot Ford for 20 years, dealers felt the impact immediately. "We lost 30% of our business overnight," she told us. "All those orders for birthdays, anniversaries, and customer appreciation events from the dealership just vanished. I had to let go of my part-time help. That's 3 jobs gone just from my small shop alone." The ripple effects extend to municipal budgets as well. Patriot Ford generated over $100,000 annually in local tax revenue, money that funded essential services like police, fire protection, and schools. Without that revenue, Whiteville faces difficult choices about which services to cut or which taxes to raise on remaining businesses and residents. "We're looking at having to reduce our police force by 2 officers, explains Whiteville City Manager Robert Johnson. "That might not sound like much in a big city, but in a town our size, it's a significant reduction in public safety resources. And that's just one impact of losing Patriot Ford. And it's not just Whiteville. From Lock Haven, Pennsylvania to small towns across Colorado, communities are watching their Ford dealerships, often institutions that have been there for generations, shut down or consolidate, taking jobs and economic vitality with them. In Alamosa, Colorado, the closure of Valley Ford ended a 67-year presence in the community. "My grandfather started this dealership after World War II," says former owner James Peterson. "We survived recessions, oil crises, and the 2008 financial crash. But we couldn't survive Ford's current leadership and their impossible demand." But here's the truly insidious part of this crisis. Ford's decisions at the top are creating a vicious cycle that's impossible for small-town dealers to escape. First, Ford pushed dealers to invest millions in electric vehicle infrastructure, promising it was the future. Many took on debt to comply. Then, as their EV strategy faltered, Ford began focusing on their most expensive models, like the $75,000 F-150 Lightning, vehicles completely out of reach for most small-town buyers. "They're asking us to sell $75,000 trucks in communities where the median household income is $45,000, explains a dealer who asked to remain anonymous for fear of retaliation from Ford. "The math simply doesn't work. The pressure doesn't stop there. Ford has been imposing increasingly stringent facility requirements on dealers, mandating costly renovations and brand image upgrades for small dealerships operating on thin margins. These mandates can be the final straw. I was told we needed to invest $1.8 million in facility upgrades if we wanted to keep our franchise," reveals a dealer from a small Midwestern town. "That's more than our total profit for the past 5 years combined. When I asked how we were supposed to afford that, the Ford representative suggested we get creative with financing. They knew it was impossible, but it gave them a reason to terminate our agreement when we couldn't comply." Now, with Ford's sudden strategic shift, delaying large electric vehicles to 2028 and pivoting to smaller, more affordable models, dealers are left with infrastructure investments they can't recoup and inventory strategies built around products that Ford is no longer prioritizing. "It's like they keep moving the goalposts but expect us to score anyway," our source continued. "At some point, you just can't keep up." Ford's desperate strategy shift. The most damning evidence of Ford's crisis is their dramatic strategic reversal that CEO Jim Farley recently announced, a tacit admission that their entire approach for the past 3 years has been catastrophically wrong. After years of pushing all in on large, expensive electric vehicles like the F-150 Lightning and investing billions in manufacturing capacity for vehicles consumers don't want, Ford is now slamming on the brakes. They've delayed the launch of their full-size electric pickup and e-Transit van to 2028, a 3-year postponement that speaks volumes about the failure of their current offerings. Instead, they're desperately pivoting to develop affordable, smaller EVs aimed at the $30,000 price point, vehicles they should have been building from the start. This isn't a minor course correction, it's a complete strategic reversal, explains automotive industry consultant David Rodriguez. When a company this size makes such a dramatic shift, it means their entire previous approach was fundamentally fundamentally flawed. The timing of this reversal couldn't be worse. Ford has already invested over $20 billion in their electric vehicle strategy, including retooling factories, developing platforms, and securing battery supply chains, all focused on the premium electric vehicles they're now walking away from. It's like building an expensive house and then deciding halfway through that you want it in a completely different location, says auto manufacturing expert Richard Thompson. You can't just move what you've built, you have to start over while still paying the mortgage on the first project. That's the financial hole Ford has dug for themselves. This strategic whiplash is creating chaos within Ford's own organization. Sources inside the company describe a culture of fear and confusion, with executives afraid to challenge decisions even when they see problems coming. There's a growing disconnect between the public messaging and the internal reality, says a Ford manager who requested anonymity. Publicly, it's all about confident transformation and strategic adjustments. Internally, we're watching projects get canceled after years of work, budgets slashed overnight, and entire teams reassigned with no clear direction. The atmosphere is toxic. But Ford isn't just battling their own mistakes. They're facing intensifying competition from all sides. Chinese manufacturers like BYD are producing lower-cost electric vehicles that make Ford's offerings look overpriced and underwhelming. Traditional competitors like Toyota are dominating the hybrid market, the very space Ford is now scrambling to re-enter. Ford abandoned the affordable car market just as consumers started demanding exactly that, notes market analyst Jennifer Williams. They discontinued the Focus, Fusion, and Taurus to focus on high-margin trucks and SUVs, but now they're realizing that was a massive miscalculation. The numbers tell the story. While Ford was busy pushing expensive trucks, sales of subcompact crossovers increased by 20% and compact cars saw a 12% boost. Meanwhile, truck sales declined by 4%. Ford zigged when the market zagged, and now they're paying the price. Even more concerning is the technology gap that's opening between Ford and its competitors. Toyota and Hyundai have been systematically improving their hybrid systems for over 20 years, achieving levels of reliability and efficiency that Ford can't match. Chinese EV makers have leapfrogged Western automakers in battery technology and manufacturing efficiency. Ford is now trying to catch up in areas where others have a decade or more head start, explains automotive technology analyst Sarah Chen. They're facing competitors who are already on their fifth or sixth generation of technology, while Ford is still working on their second. That's not a gap you close quickly, especially when you're losing billions each quarter. The financial time bomb about to detonate. Ford's current financial situation isn't just bad, it's potentially catastrophic. Behind the press releases and corporate spin lies a company facing multiple existential threats simultaneously. First, there's the profitability crisis. Despite record revenue of $50.2 billion last quarter, Ford posted a $36 million net loss. That's like a restaurant serving more customers than ever before but still losing money. A fundamental business failure. The revenue numbers are a distraction, explains financial analyst Marcus Johnson. Ford wants investors focused on the $50 billion coming in, not the fact that they're spending more than $50 billion to generate those sales. It's like bragging about how much you sold your house for while hiding that you lost money on the deal. This profitability problem isn't evenly distributed across Ford's business. Their commercial division, Ford Pro, posted a healthy $2.3 billion EBIT, earnings before interest and taxes, but that success is being completely overwhelmed by losses elsewhere in the company. Then there's the dividend debacle. Ford is committing to pay shareholders 75 cents per share while only earning 11 cents per share. This isn't sustainable financial management. It's a desperate attempt to prevent a stock collapse that would trigger even more serious consequences. When a company pays out 7 times what it earns in dividends, it's not a sign of strength, it's a sign of panic, explains financial analyst Michael Torres. They're burning through cash reserves and borrowing capacity to maintain an illusion of stability. The mathematics here are simple and brutal. Ford has about 4 billion outstanding shares. At 75 cents per share, they're committing to pay out roughly $3 billion in dividends this year. But at their current earnings rate of 11 cents per share, they're only generating about $440 million in profit, leaving a $2.5 billion shortfall that must come from somewhere. They're effectively borrowing money to pay dividends, notes corporate finance expert Dr. Lisa Chen. It's financial engineering that might keep the stock price from collapsing in the short term, but it's digging an even deeper hole for the company's future. Ford's warranty costs reveal deeper quality issues that continue to drain resources. The company spent $2.3 billion on warranty claims last quarter alone, $800 million more than the previous quarter. This isn't just a financial problem, it's a reputational one that drives customers away. What's particularly alarming is that these warranty costs have been rising despite Ford's own internal quality initiative that was supposed to reduce defects. The company has invested hundreds of millions in quality improvement programs that are clearly failing to deliver results. When warranty costs keep rising quarter after quarter despite specific programs to address them, it suggests fundamental issues with design, manufacturing, or supplier management, explains quality systems expert James Peterson. These aren't problems you fix with Band-Aid solutions or PR campaigns. They require deep structural changes to how vehicles are designed and built. The tariff miscalculation further demonstrates how Ford's leadership has lost control of their own business fundamentals. Their $2 billion tariff expense for 2025, nearly triple their original estimate, isn't just an accounting error. It's evidence of a company that can no longer accurately predict or manage its own costs. Missing tariff projections by $1.3 billion is inexcusable for a global automaker, says international trade expert Maria Rodriguez. These policies don't change overnight. Ford either wasn't paying attention to obvious policy signals, doesn't understand their own supply chain exposure, or was deliberately downplaying the impact to investors. None of those explanations is reassuring. Perhaps most concerning is Ford's debt situation. The company is carrying substantial debt while facing declining cash flow from their core business. As interest rates remain elevated and credit conditions tighten, Ford's financial flexibility is severely constrained. They're caught in a classic debt trap, Torres continued. They need to invest heavily to catch up in electric vehicles and address quality issues, but they don't have the free cash flow to do it without taking on more debt, which further strains their finances. The numbers tell a disturbing story. Ford's automotive debt stood at nearly $20 billion at the end of the last quarter, while their cash and cash equivalents have been declining. Their credit rating remains just one notch above junk status, meaning any further deterioration could trigger higher borrowing costs and restricted access to capital markets precisely when they need financing most. This financial pressure cooker explains why Ford is closing dealerships in small towns across America. It's not part of a thoughtful, strategic realignment. It's a desperate attempt to stem the bleeding by cutting off what they perceive as lower-performing extremities to save the core. The shocking truth about Ford's future. What does all this mean for Ford's future? The outlook is grim, and the company's own actions speak louder than their public statements. Ford's decision to delay their major electric vehicle launches to 2028 isn't just a strategic pivot, it's an admission that their current approach has failed. They've wasted precious years and billions of dollars pursuing the wrong strategy while competitors have surged ahead. Ford is essentially starting over in the EV race, explains automotive technology expert Dr. James Chen. They've squandered their early mover advantage with the Mustang Mach-E and F-150 Lightning by focusing on high-end vehicles with limited market appeal instead of building affordable options that could achieve mass adoption. The consequences of this restart extend far beyond just the electric vehicle business. Ford has been reorganizing its entire company around the transition to electric vehicles, including splitting the business into distinct internal divisions: Model E for electric vehicles, Ford Blue for traditional combustion engine products, and Ford Pro for commercial vehicles. They created an organizational structure built around a strategy they're now abandoning, notes corporate management expert Dr. Rebecca Lewis. That's like designing a house around a central courtyard, then deciding halfway through construction that you don't want a courtyard anymore. The entire structure is compromised. This reset comes at the worst possible time. The global automotive industry is facing tightening credit conditions, rising interest rates, and consumers increasingly unable to afford new vehicles. The average new vehicle now costs about $11,000 more than it did 5 years ago, pushing many potential buyers out of the market entirely. The auto market is entering a phase where affordability will be the primary driver of sales, explains economist Dr. Thomas Baker. Ford has spent the last 5 years eliminating their affordable vehicles and pushing consumers toward higher-priced models. Now they need affordable options again, but developing new vehicles takes years, not months. This timing problem extends to Ford's manufacturing footprint as well. The company has invested billions in converting factories for electric vehicle production, facilities that will now be underutilized as they delay their major EV launches. Meanwhile, they've reduced capacity for the more affordable conventional vehicles they now realize they need. They've created a mismatch between their manufacturing capacity and what the market actually wants, explains manufacturing strategist Robert Johnson. Retooling factories again will cost billions more and take years to implement. You can't just flip a switch and start building different vehicles. Ford's only bright spot is their commercial division, Ford Pro, which delivered a robust $2.3 billion in EBIT last quarter. But one successful division cannot carry an entire company, especially when other units are losing billions. It's like having one healthy organ in a body where everything else is failing, notes industry analyst Sarah Johnson. Ford Pro's success is commendable, but it can't compensate for the massive losses elsewhere. Even this bright spot faces challenges. Ford Pro's success depends heavily on fleet sales to businesses, government agencies, and rental companies, sectors that are highly sensitive to economic cycles. If the broader economy slows, as many economists predict, Ford Pro could see its earnings power diminish precisely when the company needs it most. The company's stock tells the story of investor skepticism. Despite a modest recent improvement in relative strength rating from 70 to 75, Ford shares remain well below their peak. The market isn't buying Ford's turnaround narrative, and for good reason. Smart money is watching what Ford does, not what they say, explains investment advisor Robert Williams. And what they're doing, closing dealerships, delaying key products, reversing strategy, tells a story of a company in crisis, not one confidently executing a vision. This disconnect between Ford's public messaging and their actions creates a credibility gap that makes their turnaround even more challenging. Consumers, dealers, suppliers, and investors all see the contradiction between the optimistic press releases and the reality of product delays, quality problems, and dealership closures. Trust is the most valuable currency in business, and Ford is quickly spending down their trust reserves, notes corporate reputation expert Dr. Emily Chen. Once stakeholders stop believing your promises, recovery becomes exponentially more difficult. Why would a dealer invest millions in your vision if your last vision was abandoned? Why would consumers commit to your platform if you might not support it in 5 years? For the communities like Whiteville that have lost their Ford dealerships, the company's corporate troubles translate into real human impact. The parts manager who lost his job, the service technician who had to move his family to find work, the local businesses that depended on the dealership's employees and customers, these are the true casualties of Ford's financial mismanagement. The human cost often gets lost in discussions about corporate strategy and stock prices, says community impact researcher Dr. Michael Harris. But for every point Ford's stock drops, or for every billion in losses they report, there are real people whose lives are being upended. These aren't just statistics. They're families facing profound uncertainty and communities losing part of their identity. What this means for you. If you're a Ford owner, investor, or considering buying a Ford vehicle, the company's crisis has direct implications for your financial future. For current Ford owners, declining dealership networks mean reduced service options and potentially longer wait times for repairs. As more dealerships close or consolidate, the convenience factor that may have influenced your purchase decision is eroding. Owners in small towns are increasingly forced to drive long distances for warranty service or recall work. I used to get my F-150 service 10 minutes from my house, says Thomas Jenkins from rural Pennsylvania. Now the nearest Ford dealer is over an hour away. What happens if my truck breaks down? A simple repair now costs me a full day of lost work plus transportation costs. The company's quality issues, evidenced by their ballooning warranty costs, suggest that reliability problems aren't being adequately addressed. This could mean more frequent repairs and maintenance headaches for owners. Even more concerning for current owners is the potential impact on resale values. As Ford's reputation for quality deteriorates and new vehicle sales slow, the value of used Fords tends to fall faster than competitor brands. This creates a financial impact even for owners who haven't experienced direct problems with their vehicles. I was shocked when I tried to trade in my 3-year-old Explorer, says Sarah Mitchell from Ohio. It had depreciated almost 40% more than my neighbor's Toyota Highlander of the same age with similar mileage. That's thousands of dollars out of my pocket for choosing Ford. For those considering a Ford purchase, the company's strategic confusion raises serious questions about future product support. Will the vehicle you buy today still be supported in 5 years if Ford continues to abruptly shift strategies and close dealerships? Will replacement parts remain readily available? Will service technicians be properly trained on your specific model? The company's history of abandoning vehicle lines is particularly concerning. The Focus, Fusion, and Taurus were all discontinued despite having loyal customer bases. More recently, Ford canceled the Oak Electric Lincoln SUV after taking customer reservations and deposits. This pattern suggests a company willing to abandon products and customers when strategies change. Before buying any vehicle, you need to consider not just what it offers today, but what support will look like throughout your ownership period, advises consumer advocate Rebecca Thompson. Ford's track record in this area should give buyers serious pause. Ford's focus on high-margin, expensive vehicles has left budget-conscious buyers with fewer options. With the elimination of the Focus, Fusion, and Taurus, affordable Ford sedans have disappeared from the market. Now, with their pivot to smaller EVs and hybrids still years away, potential buyers face limited choices. This void in the affordable segment is particularly problematic given economic realities. With the average new vehicle transaction price now exceeding $47,000 and interest rates remaining elevated, many Americans simply cannot afford new vehicles. Ford's product lineup ignores this large segment of potential customers. It's astonishing that in today's market, Ford doesn't offer a single vehicle with a starting price under $30,000, notes automotive pricing analyst Richard Brown. They've completely abandoned entry-level buyers, leaving that entire market segment to competitors. For investors, Ford's unsustainable dividend policy and persistent EV losses create significant long-term risk. While the 75-cent dividend might seem attractive, a payout ratio of nearly 700% is a red flag that this level of return cannot continue indefinitely. Ford's dividend is essentially funded by depleting company resources rather than from sustainable earnings, explains financial advisor Thomas Wilson. That's not a dividend, it's a liquidation payment. And when companies start liquidating assets to maintain dividends, it rarely ends well for investors. The company's strategic vacillation also makes it nearly impossible for investors to assess future prospects with any confidence. How can you value a company that completely changes direction every few years? What assumptions can you reasonably make about future cash flows when today's investments might be abandoned tomorrow? Investing is about predicting future returns based on current actions, notes investment strategist Lisa Martinez. Ford's constant strategy shifts make those predictions little more than guesswork. They've become uninvestable for serious long-term investors. The choice is yours. Remember what I said at the beginning? While everyone else is still believing Ford's optimistic press releases, you could be protecting yourself from the automotive collapse that's already sending shockwaves through small-town America. Now you understand the full picture. You've seen how Ford's financial crisis is forcing dealerships like Patriot Ford in Whiteville, North Carolina to shut their doors without warning. You know about their unsustainable dividend policy, their massive EV losses, and their desperate strategy reversals. This isn't just about a car company struggling, it's about an American icon potentially heading toward a financial reckoning that will impact communities, employees, customers, and investors. So what will you do with this information? If you're a car buyer, will you commit tens of thousands of dollars to a company undergoing such dramatic upheaval? If you're an investor, will you trust Ford's promises of future profitability when their current strategies are failing so spectacularly? If you're a small-town resident, will you fight to protect your local dealerships before they become the next Patriot Ford? The warning signs are clear for those willing to see them. Empty dealership lots in places like Whiteville aren't just local business failures, they're canaries in the coal mine for Ford's larger collapse. Hit subscribe now and turn on notifications. Ford's crisis is still unfolding, and our next update could be the one that saves you from making a costly mistake, whether that's buying a vehicle that loses support, investing in a company with fundamental financial problems, or failing to prepare your community for economic changes that might be coming. Are you a Ford owner, investor, or dealership employee? Have you noticed changes in your local Ford dealer network? Tell us in the comments below. Your experience could help others understand what's really happening behind the corporate spin. Remember, in today's automotive market, information isn't just power. It's financial protection in an industry undergoing seismic change.